Um, Good afternoon, everybody, and a very, very warm welcome to our FICA seminar. Now, FICA is a statute that regulates money laundering or anti-money laundering, surely needs no introduction. But not everyone may be aware of or conversant with the recent changes to FICA, which, among other things, significantly expands the category of accountable institutions. These amendments were gazetted in November, became effective in December, and really snuck in the sense of they were gazetted or became effective at a time when many people's minds were on holidays and holiday plans rather than amendments to and compliance with FICA. So I'm going to hand you over to my very, very competent people, or the very competent people in my team, and they are going to walk you through these amendments, what they are, how they impact you, if they impact you, what would be the sanctions for non-compliance and the like. So without taking much more of your time then, Ira and I are directors or partners, and Ira's a partner in the real sense of the word, or in every sense of the word. Both of us are in banking and finance regulatory team. Then we have Amelia, who's a recent acquisition to our team in the sense that she's a candidate legal practitioner. And might I abuse my position here, Amelia, to say really one of the best candidate attorneys, or CLPs as they're now styled, that we've honestly had the good fortune of having in our team. And last but certainly not least, Lindo. Lindo is an associate in our team, and we are very lucky to have pinched him from a competitor law firm. And the last thing I want to add is that we were aware of these changes. These changes, although gazetted only in November and effective only in December, have been a long time in the coming. So we've really, as a team, done a significant amount of work in providing you with easy solutions and a very easy way of meeting your compliance obligations. So thanks for allowing me that time, and I hand over to you, Ira. I think each of you can say which aspect of the amendments you'll be speaking to, rather than my making that on your behalf. So,
thank you. Thank you very much, Angela. In the interest of time, I'm going to hand over to Lindo straight away to tell us where this is coming from and tell us about the Financial Action Task Force and why are we sitting in the situation where a lot of us are now, namely that we are accountable institutions. So Lindo, I'm going to hand over to you, and afterwards I will tell you what does it mean now that you are an accountable institution, what are your obligations. So over to you, Lindo. Thank you, Angela.
Thank you very much, Ira. Thanks, Angela. So without wasting much time, I'll be taking you basically the history of FICA and how we have certain obligations as far as the Financial Action Task Force is concerned. So I'll be explaining what the Financial Action Task Force is, which is essentially a global money laundering and terrorist financing watchdog. What they basically do is to provide guidelines and standards internationally and impose that on certain countries. They also provide recommendations to countries. And as far as these recommendations are concerned, the aim is to try and assist countries to tackle illicit financial flows. In some instances, like South Africa, these recommendations would include robust framework of laws. In the case of South Africa, this would be our FICA law, regulations, and most importantly, measures to ensure national authorities like the financial intelligence sector have sufficient action to detect and disrupt the illicit financial flows. Now, South Africa became a member of the Financial Action Task Force in 2003 and is one of the 39 member countries. As a member, South Africa was evaluated in 2019. In terms of this evaluation, the Financial Action Task Force identified 12 key findings and recommendations, which South Africa required to implement as far as its financial system and laws are concerned. In 2021, there was a more follow-up from the Financial Action Task Force on these recommendations, and South Africa was given a year to basically demonstrate progress to address the recommendations that were imposed by the Financial Action Task Force. Now, as far as this is concerned, that year came, it was supposed to be last year, and an extension was given until February this year. So February this year, South Africa will be convincing FATF why it should not be included in the grade listing list of certain countries that are part of that list. And South Africa has, as a result of this now, tabled a number of amendments to FICA to basically demonstrate compliance with these laws. And I think this is why we are particularly here today. It's merely because of the recent amendments to FICA and what this particularly means. And for that, I will hand over to my colleague, Era, who will speak on the added institutions in terms of FICA and also the importance of being an accountable institution.
Thank you, Lindo. So absolutely, FATF has told us we've been naughty, and if we don't comply with their recommendations, we are going to become grey listed. What does that mean? If we are grey listed, it means that we are a high risk jurisdiction. So anybody from overseas wanting to deal with us, enter into financial arrangements and so on, will have to do extra due diligence on entities in South Africa, which is expensive, and they may decide then not to deal with us at all. So it could have severe implications for the country and our GDP and the like. So in order to avoid becoming grey listed, like Lindo has mentioned, we've made a lot of changes to many pieces of legislation, including FICA. And most important for today's session is the fact that we now have new entities that will constitute, or that already constitute, accountable institutions. So if you don't know what an accountable institution is, I'm sure we've all had the frustration of wanting to open a bank account, but the bank tells us we need to be FICA'd. So they ask us for certain information, which they sometimes refer to as KYC or know your client or customer due diligence information. Likewise, if you instruct attorneys such as ENSafrica, we would say to you, we can't accept the instruction unless we FICA you. Now, these new entities will have to do the same as banks and lawyers now, and we already have to do or comply with obligations in terms of FICA since the middle of December. So the new entities are life insurance business, credit providers under the NCA, so if you are registered or supposed to be registered in terms of the NCA, and then also certain credit providers that are excluded from the ambit of the NCA. So if you are a credit provider and you provide credit to juristic persons above R1 million, or you provide credit to the government and you didn't have to be registered in terms of the NCA, doesn't matter for purposes of FICA, you would still constitute an accountable institution. Angela, you are NCA expert. Is there anything that you wanted to add here?
Thank you, Yara. Not really at this stage. Safe to say that there are quite a few uncertain issues here, one of which I'm just going to touch on, and that is whether persons who provide incidental credit agreement would be impacted by this new legislation and would in fact have to become accountable institutions. If I may take this opportunity to say that people who do extend credit should revisit their credit agreements, should revisit their credit applications, because very often those are headed as trade facilities, but in substance they are credit agreements. So as an adjunct to becoming FICA compliant, one should also take this opportunity to look at one's credit agreements. Thanks, Era.
Thanks, Angela. Financial services providers in terms of the Financial Advisory Intermediary Services Act. And previously, in terms of FICA, if you were an FSP just because you were dealing in short-term insurance or providing intermediary services or advice in respect of short-term insurance, you were excluded from the scope of FICA. That is or from Schedule 1 to FICA, where we see accountable institutions being defined. That is no longer the case. If you're in the business of being a money or value transfer provider, previously it said in the business of being a money remitter. Now we've got this added category of value transfer provider. We will have to wait and see what this involves. It would involve things like airtime providers, but it may also have the side effect of catching other value transfer providers in the net. And then one that has been giving a lot of our clients quite a few headaches. If you're in the business of dealing in high value goods, where an item is above 100,000 Rand, doesn't matter to whom you sell the goods, whether you sell it to large companies, whether you sell your goods to human beings, whether you're selling a mountain bicycle above 100 million Rand, 100,000 Rand to a human being, or whether you're selling equipment to distributors or large organizations, you will tick this category. Also overseas, you will only tick this category if the person or the buyer pays you in cash. That is not the case here. Even if the person pays by EFT, you would be seen to be a dealer in high value goods. It is not the shopping basket. So for example, if you sell goods of 20,000 Rand each and you sell 5 items, we don't think that would trigger this provision. But if you do sell an item above 100,000 Rand, whether it's a piece of art, bicycle, whether you're a mine, motor vehicle dealer, Krugerrand dealer, the list is actually endless. You are now an accountable institution. We can go to the next slide, Lindo. So also certain crypto asset service providers now fall under the definition of accountable institution. We saw this coming quite a while ago. Our team wrote quite a few articles on this last year. And then certain trustees, commercial trustees, and entities which, for example, establish companies. We don't mention each and every single new accountable institution here, but that basically is a summary of the new accountable institutions. Now, what does it mean when you are an accountable institution? If you're an accountable institution, you have to comply with the whole of FICA. And our team had a debate recently, do these obligations only kick in once you register as an accountable institution? I definitely do not think so. I think these obligations kicked in the day the amendments to the schedules became effective in December. So first of all, we have to appoint a compliance officer, very often referred to as the money laundering control officer. You can also appoint reporting officers, but you don't have to, but you have to have a compliance officer. It will be that compliance officer that would then register the accountable institution with a Financial Intelligence Center on their online system GoAML. It is a free registration, and the FIC has issued guidelines on how to do this registration. Your compliance officer would get login details and the like, and then complete this registration. Incredibly importantly, you have to develop and implement a risk management and compliance program, commonly referred to as an RMCP, fancy name for an AML policy, an anti-money laundering policy based on the risk of the client. The higher the risk of the client, the more you have to do to verify the client's identity. If the person says, my name is Amelia, the higher the risk of Amelia, the more you have to do to check that Amelia is in fact Amelia. And this needs to be documented in your RMCP. And then you have to conduct training. How much training, how often the training needs to occur, that is not clear, but certainly you have to do some training. And at this point, before I carry on with the remaining 3 obligations imposed on accountable institutions, I'm going to hand over to Amelia, who is going to take you through the requirements of an RMCP. And I just want to mention to you that if the FIC does an inspection, if they do desktop inspections quite often, the first thing they would ask you is, are you registered as an accountable institution, and when did you register? And the second thing they will ask you is for a copy of your RMCP. You would normally get a short deadline. You'll get an email in your inbox on a Monday, and they will ask you for a copy by the Friday. And then they will mark it against this list that Amelia is going to discuss with you now. Over to you, Amelia.
Thank you so much, Era. So the requirement to have an RMCP is set out in section 42.1 of FICA, which essentially says that all accountable institutions must develop, document, maintain, and implement a program for anti-money laundering, counter-terrorist financing, and proliferation financing risk management and compliance. The RMCP must be approved by the board of directors or the person or group of persons who have the highest level of authority, and this group of persons is also responsible for ensuring compliance with the RMCP. Now, the substantive requirements for the RMCP are set out in section 42.2 of FICA. As Era said, these requirements are very important to comply with from the FIC's perspective, and they are also very onerous, and it makes it very difficult to draft the RMCP. So I am going to detail all of them briefly, but I would just like everyone to bear with me because there are quite a few. So the first requirement is the RMCP must enable an accountable institution to identify, assess, monitor, mitigate, and manage risk. And essentially that is the risk that is posed by the products or services that you offer being used for money laundering or terrorist financing purposes. Secondly, a very important requirement is that the RMCP must provide for how the accountable institution will determine whether your prospective clients or current clients are entered into a business relationship with the accountable institution or a single transaction. In terms of FICA, a business relationship is an arrangement whereby the client and the AI conduct transactions on a regular basis, and a single transaction is defined in opposition to that term. This is important to note in your RMCP because, as we'll see as we go through the requirements, many of the requirements apply only to clients you have entered into a business relationship with and not to those you just concluded once-off single transaction with. And the reason for that is you have much more information about clients who you do conclude business relationships with. Right, the next 3 requirements. First, you must provide for section 20A. This section essentially says that accountable institutions can't conclude transactions with anonymous clients or with clients with obviously false or fictitious names. Second, you must provide for the establishment and verification of the identity of your clients, and this is something that Era will touch on, I believe, in a bit more detail. And finally, you must provide for the manner of determining whether transactions are consistent with the accountable institution's knowledge of the client. And this is an example of an obligation which would only apply to clients you conclude a business relationship with. The next 2 requirements, you must provide for ongoing due diligence and monitoring of business relationships, and you must provide for additional due diligence for legal persons, trusts, and partnerships. And that's because these types of structures lend themselves more to money laundering and terrorist financing, and therefore pose a higher risk. The next 2 requirements, the RMCP must provide for the way that the accountable institution will confirm client information where it thinks that the information that it previously obtained might be untrue. And secondly, it must provide for how complex and unusually large transactions, as well as unusual patterns of transactions, are examined by the institution. FICA also specifies that in your RMCP, you have to provide that written findings will be made based off of this examination. Beyond that, the next 3 requirements: you must provide for client due diligence when the accountable institution suspects that a transaction is suspicious or unusual. Second, you must provide for the way that the accountable institution will terminate an existing business relationship. And thirdly, you must provide for the way that the accountable institution will determine whether a prospective or existing client is a foreign or domestic PEP or prominent influential person. And that's because these persons who garner more influence also pose a higher risk of money laundering and terrorist financing, and you need to adjust your measures appropriately. The next 3 requirements: you must provide for the way in which the accountable institution conducts enhanced due diligence, that's specifically for clients who pose a higher risk, and also when simplified due diligence is permitted, where you think that your client is below that higher risk threshold. You must also provide for the manner and place of keeping records, and provide for how you will determine which activities must be reported to the FIC. Linked to that, you must also set out the exact process that you will follow when reporting activities to the FIC. And you must also provide for where you have branches in foreign jurisdictions, how the RMCP will be implemented in branches outside of South Africa. If you determine that the host country of the foreign branch doesn't permit the implementation of measures under FICA, you must inform the FIC and take into consideration the level of risk of the host country and think about alternative measures you can impose to address that risk. Linked to that, a new requirement is subsection QA, which says that you must provide for the way in which group-wide programs can be implemented in the RMCP, such that you can make sure that all of the branches comply with their obligations under FICA, so that you can exchange information about client due diligence, and so that you can exchange information relating to suspicious or unusual transactions. Of course, because you're exchanging this information amongst your branches, you would also need to have adequate safeguards to protect the confidentiality of client information. Then the 2 final requirements in terms of this section: you must provide for the process by which the accountable institution will actually implement the RMCP, and provide for any other prescribed matter. Then subsection 2A, 2B, and 2C give us just a little bit more detail about these requirements. 2A provides that if any paragraph is not applicable, you must indicate it in the RMCP and explain why. This is particularly important, for example, with subsection Q, where you as an accountable institution may not have branches in foreign jurisdictions, but that doesn't mean you can simply ignore the requirement. You'd have to set out this requirement does not apply because you don't have foreign branches. Subsection 2B, as I've already noted, the board of directors is responsible for approving the RMCP. And finally, according to subsection 2C, you are required to review the RMCP at regular intervals. So I know that that was a mouthful, but I'm now going to pass over to Ira, who will take us through the obligations of accountable institutions in more detail.
Thank you, Amelia. Yes, it was indeed a mouthful, and I know it's difficult to absorb, and we will be sharing our slides with all the attendees. So we've dealt with the first 4 obligations imposed on accountable institutions: appoint a compliance officer, register with the FIC, do training, and have an RMCP. And Amelia set out the checklist for an RMCP. If you do decide to draft your own RMCP, make sure you do address each and every single thing that Amelia has just discussed with us. The remaining 3 duties would be customer due diligence. This goes by many names. Some people just simply call it FICing a person, KYCing a person, customer identification, verification. It is all that and more. It also includes things like sanction screening to see if somebody has been sanctioned by the United Nations. When you do sanction screening, please also remember the data protection, the POPI consequences there as well. So this is knowing who your client is and doing more for clients who are higher risk. Record keeping. You have to keep record of your customer due diligence information. You don't necessarily have to keep copies of documents, but you need to keep record of what you have done to make sure that a client is who the person says he is, and to get to know the client better. Customer due diligence also involves things like ongoing due diligence. What do you do if you doubt the veracity of information given to you by a client? What if you can't FICA a client? In most instances, you would have to terminate the business relationship or not enter into a single transaction. And that also needs to be addressed in your RMCP. So record keeping, your CDD information, and information relating to your transactions must be kept. And you also need to tell the FIC how you're keeping these records and where you're keeping these records in your RMCP, and for how long are you keeping the records. You need to keep these records, if you read the Companies Act and FICA together, for a period of 7 years. And then there are reporting requirements. A lot of people think that every single transaction needs to be reported to the FIC. That is not the case. We have 3 types of transactions that must be reported to the FIC. Cash transactions of 50,000 Rand or more. You also have to report suspicious or unusual transactions. If something is dodgy with a transaction, you need to report it to the FIC. And then also certain activities, for example, if you're dealing with or have property in your possession which is related to UN-sanctioned individuals or entities. And lastly, reporting as well, the FIC may ask you for information, for example, if a certain person is a client or not. We can move on. Amelia, I've dealt with this. And extra due diligence if you're dealing with legal persons, trusts, or partnerships. And then what is going to happen if you don't comply with FICA? Well, penalties can range from 50 years in a nice South African jail to 100 million Rand. There's also scope for personal liability on the board of directors. But most importantly, we are often asked if we have a grace period for complying with these provisions. And also in the chat, somebody asked, do we have an 18-month grace period? Absolutely not. These obligations have kicked in, but what the FIC has said in a media statement is that it will probably only impose remedial sanctions in the first 18 months. So it will probably, on the new accountable institutions, only do inspections and give naughty notices and tell you to change your ways. And it will probably then only institute financial sanctions after the 18-month period. The problem we have is once you are on the naughty list, you can expect the FIC to come back in 18 months and do an in-person inspection. And if they find wrongdoing, you are very likely to be fined. Finally, I want to note that Angela has also mentioned that we saw these provisions coming and we saw these amendments coming. We've been writing on it the whole of last year, and we have developed a FICA toolkit to assist our clients. It's got an RMCP template in there that complies with those very strict requirements set out in section 42 that Amelia discussed. It includes a board circular informing the board of these amendments. It includes a guide setting out the FICA compliance requirements, which we've just brushed over today. It includes an hour of recordable training and an hour of Q&A. So we've got details of it in the slides, and we will be sharing it with you. Somebody has also asked me, what if we, in the chat, what if we buy goods in bulk or sell goods in bulk like coal? Will we be an accountable institution, a high value dealer if we sell the bulk of coal for over 100,000 Rand? The answer is probably. We are not sure because there's no definition of items. So I just wanted to answer that one because I accidentally closed it on the chat. We are out of time now. I would like to thank you very much for joining our session today. If you have any questions, please feel free to contact any of the presenters, and we look forward to hearing from you. Thank you very much to the presenters, and thank you very much to the attendees. Goodbye.